Welcome to Venture with Joe and Cody, where we take a deep dive into the minds of leaders and innovators making a real impact today. I'm Joe.
And I'm Cody. And we're here to bring you the raw stories, the successes, and the setbacks that these trailblazers have experienced in their journey to where they are today.
Every week, we sit down with a new guest who's ready to share their insight and advice on business, entrepreneurship, and making a difference in their community. From local community members to industry experts, you're going to get the unfiltered truth behind their success.
So whether you're an aspiring entrepreneur, a seasoned professional, or just curious about the business world, join us for a journey of learning and inspiration.
So let's grab a drink, settle in, and let's get started. This is Venture with Joe and Cody. Hey guys, welcome to another episode of Venture with Joe and Cody. My name is Joe Skipper. I'm the owner of Skipper Realty Group, brokered by eXp Realty, and I'm with Cody Wilhelm with Residential Mortgage. What's up, my man?
What's going on? How are you?
I'm good. Today, again, with us, I feel like there's always a technical difficulty. We did another recording that was about 20-something minutes long, and it was only me talking to myself. I could hear you. I could see you. We had a great conversation, and then when it came down to record, it was just me looking into the camera, laughing at the jokes that you said, and then responding to nothing.
And it would actually be really kind of funny to post it. Probably only funny for us, but
yeah. You know what I got a suggestion of is to do we need to do one of our live streams, the baby face. Have you seen those? The AI generated baby face.
Yeah.
So I think I might try that. At least maybe our advertisement for like one of our podcasts. Maybe I'll just do a 30-second clip of like you and I talking.
Oh, that'd be great.
So I might try that. But
those are funny.
Yeah. Well, I don't have anything crazy planned. However, the rates are still high. There's still buyer demand. This is a weird market. Because it's not supply and demand at this point, to me. Maybe you have a different opinion, but it's not. The demand is still high, the supply is still low, but the rates are driving everything.
Yes.
And so people are like, well, there's less supply. We can't even go off of the traditional way of thinking. Like, oh, we just have a ton of supply, so homes are sitting on the market longer. It's not the case. It's just a weird market, just a really weird market. So to even explain to sellers and buyers, it's just so weird. I don't know. It's the same to you or what?
Totally same. It's just an affordability thing. I think there is, if anything, there is a ton of demand, but it's just the affordability piece that when people, they want to get out of their rental, they want to move, and then they look at the numbers and it's just stretches most people a little more thin than what they want, or maybe they've just done some quick research and don't even really know what a payment looks like on it, but they love the $500,000 home, so that's what they want, and then they see the payment and they're like, maybe we're just going to rent for another year.
Yep. And that goes for even homeowners, because homeowners that are in the 3% rate are still wanting to leave. They're just comfortable staying. So you have people not even, and I don't even know if that factors into the demand that people are talking about. It's not just renters that are like, hey, I'd rather just rent. It's and sellers or homeowners still want to move. They just can't.
Yeah.
They're like, I got a 3% rate. I want to upsize, but I can't upsize at a 7% rate.
Right.
And I think I'm starting to see that they're not comfortable in that. They're not like, oh yeah, we'll just stay here for another 8 years. We're totally cool at 3% rate. They're all trying to figure out this new world of like, I want to get out. And if I can get out for 6, I'll be happy with that. If I can get out, and so it used to be, I think right after COVID, everyone's like, I'm staying in my house. But we're reached the point of that normal rotation for people of the 5 to 7 years that everyone's like, oh, maybe I upgrade, downgrade, move for a job. And now people are like, just can't. I can't do it. It's not a choice necessarily. It's just like, I can't. So it's just a crazy, crazy market. But it leads me to my questions that I have for you. Because as I say in our other recordings, is like everything's based on you now, Cody. It's not, you're the lender, you're dealing with the rates. I am just reacting to your rates. That's it. Like the rates that you give, that's whether I succeed or fail in life and in business. So, people are like, oh, why don't you ask Joe a bunch of questions? Like, well, Joe's sitting here waiting for Cody to get rates in a decent spot so that Joe can start selling and buying homes.
Yeah, it should be. I would guess I'll probably bring them down here in the next few days.
Well, hopefully,
but we'll see.
You've been lying this last year and a half saying that they're going to go down, and all they've done is go up.
Just got to keep people interested.
It goes for all your friends too, like in the lending industry.
Thankfully, nobody listens.
Well, I guess what I want to start with, just like I wanted to look up. I just was curious what home buyers are asking lenders in 2025, and so little chat GPT gave me some research, and here's some of the top questions. So what are current mortgage interest rates, and are they expected to change soon? Like, I kind of led into the fact that Cody's been lying the entire year, like couple years.
Yeah.
But honestly, like you can tell us the rates, and yeah, what do you think? What's from your professional standpoint, knowing that, we could all be wrong and normally we are?
Well, so I have felt like that things would improve over the last probably realistically 2 years, maybe, because it felt like that first spike in rates and everything, and it was kind of chaos, and it's like, okay, this just needs to be a quick little reset here. And then the fact where we're at and where we're going, I definitely don't anticipate there being, and I never really did anticipate there being a big drop, but I think if we've seen anything, it is slow for anything to move down. So I think putting things back into the low sixes, even the high fives, would feel like such a huge win. So I don't think it has to go down very far in order for it to feel like it's a big improvement. And I do think that that's where we will end up being, probably is somewhere in that low 5 range. But I don't know if that's going to be in 2 years, 5 years, 1 year. I do think that that's going to be a little more of a healthy number for where we're at and where home prices are at. If home prices were a lot lower, then, like, if you're in a low cost area, a 7% rate on a $250,000 house, honestly, it's not that big of an impact.
Yeah.
But when you're looking at most homes that people are buying are 5, 6, 700,000, that's a pretty big number. I think they're going to improve, but I think we still have to go through the crap that we're going through in order to get out to the other side. But I mean, it's just, I know historically 7% is not bad at all, but I think there's a little misconception there. Historically, we're at a ridiculously high price too. 7% on 150,000, or like I even just said, 250,000, not that big of a deal. Yeah, it hurts a little bit, but your payment from a 5% to a 7%, that might only be like $150 a month, which,
for sure,
it's money, but it's not like a $400 to $500 to $600 a month difference on some of those higher priced homes. So
yeah, when you're looking in the 8-9 million, it's like insane that, that what a 7% versus a 6.5 versus a 6, so
right.
Yeah, we'll just wait and see. What are the rates now? Just under 7. Yeah.
I think they're like 6.98 today, is the national average. So,
okay.
Not much has changed.
I think glance over this question, because this is very specific that ChatGPT gave me, but what type of mortgages do you offer, your company offer, and which would be best for my situation? But I think everyone has a different situation. It's kind of using like, the buyers are looking for guidance on whether it's FHA, VA, USDA, the best program for them.
Sure. Yeah. I mean, I can jump into that.
I guess how do you go about determining what is best? So what do you do? Like when someone says, hey, I need a loan, how do you go about determining what the best one is for them?
Well, usually it'll start out with how much they have to put down. I'll ask if they served in the military, because obviously that's going to tell me if they can go VA, that's going to be the best option. If not, rule it out. How much they're putting down. If they're going for a more minimal down, then it's going to be, kind of a toss up, FHA versus conventional. And then the next step is going to be credit score. So if their credit scores are like 700 and higher, I'm going to look at conventional loans first. If they're under 700, then I'm likely going to look at FHA loans first. So what I end up doing is just breaking down side by side. I'll have 2 or 3 or 4 different options for them to say, here are kind of the main options for you. One of them is going to stand out, that is the better one. And then there's others that are going to not look as good. So I ultimately like to let people decide based on the numbers, and I'll explain the differences to them. Like because there are a lot of people that are right in that low 700 credit score range. So payment wise, a conventional loan and an FHA loan might be almost identical, but then I got to go through with them short-term versus long-term. If you keep this conventional loan, you can get rid of your mortgage insurance. If you go FHA, you're going to have to refinance out into a conventional loan to get rid of mortgage insurance down the road.
Okay.
So sometimes it's a little bit more of planning that goes into it, but initially it's mostly down payment and credit score that are ultimately going to determine which option. And then if you have, unique situations where they're looking for a, specifically want to do a rehab loan or new construction or whatever it might be, those are kind of fit in their own little boxes. But usually that's kind of the main couple determining factors on which one's going to make more sense.
I have a random one, and it's not random, but I had a client ask about it. With rates, where do lenders differ? And we could go down a rabbit hole, but where, with rates, being the rates, what would you advise a client? Like, I had a buyer, like, who do I go with? The rates were pre-qualified for X.
Yeah.
Who's better? Like, so how do you guys, and I don't need a sales pitch from you, but like, how do you differentiate? Like, why would working with residential mortgage be better than working with, big bank X or, like, where do you guys differ in that case, in certain cases?
Yeah, it's a good question. And it is one that does get asked somewhat often, like what makes you any different from this company? And I would say that there's a couple things. Personally, I always sell myself more so than I do the company. I do totally support the company and there's some amazing things that we do. But usually when it comes down to it, I'm kind of selling myself more on the service. This is a career for me. This is something that I will forever do. I'm not in a call center. I'm going to answer your phone late at night. I'm going to educate you. I'm going to walk through things. I'm not just going to send you a spreadsheet and say, hey, pick which one and then go log in and click this button. It's a hands-on experience. I do think our company, they do provide some pretty amazing support from the loan officer side of it. From my side, that probably, you or a buyer or anybody would not see, just that support and that hands-on approach of, you get a whole team of people coming together. And there's some companies that I have worked with, and that was partially the case, but it's coming from more of a mindset of running the business as opposed to like a loan officer mindset. And our company has done a really good job of keeping the loan officer mindset, which is huge for us because we're looking to support our clients and referral partners, and for there to be more of an outlook on loan officer focused how we run our business. That makes a huge difference because it tends to make a lot more sense on decisions that are made rather than just like somebody pulling the strings that you can tell they've never done a mortgage before. They're just like, well, this is the right thing we should do.
Yeah. Yeah.
So it's a lot of just service based, what we can do, what we can provide. We also do have portfolio loans. So there's a lot of lenders that can't do certain things, and we can put those in our portfolio because our bank can choose to do essentially whatever loan that they want to do, as long as it's not too much of a risk for them. So we do offer a lot of kind of outside of the box options that we can keep in-house, and we service those loans. And
is there any competitive advantage? Obviously I think service is a big issue, especially on the real estate side of things. Being on the real estate side of things, it's critical, but I think it is in lending too. And that's why I think you and I get along really well, is the motto or how we run our business is very customer service oriented. Is there any, this sounds like a dumb question, but I think a lot of people have it, is like, is there any financial benefit to people, barring any programs? I'm talking like perfect buyer, qualified for $900,000 house, like, rates, is there any programs that are specific to you or other banks that say, hey, I'll save X amount of money if I went with this person? Or are mortgage rates just kind of what they are?
I mean, more or less, mortgage rates are kind of what they are. You're going to see a little bit of variation with every company. Like if you looked at 5 different companies, you're going to get 5 different fees and or rates, because we all have the same baseline that we're going off of, but then the company has to put in, every lending institution gets their base rate, if you will. And then you have to add on your margins to run the business. So you're going to see little fluctuations here and there. You might see lower rates with more of a call center type of online place, because those loan officers are typically just an hourly employee that are just kind of like order takers.
Yeah.
As opposed to loan officers like myself and like a lot of loan officers where they're going out and getting the business. So they're bringing the business. So they're going to get paid a little bit more. So there's a little bit of a variation with that. brokers versus retail. Just depends on who is getting the loan and what the overall cost is to run that business. If things are ran really minimal and people are, I mean, I hate to say it, but it's kind of like if people within the company are not compensated very well, you're probably going to get low rates because there's less margin, or there's more margin. If the employees and everybody are taken care of, you're probably going to see a little bit more. That's why you tend to see online call center type places have lower rates, because they get people in and it's just a volume thing. Like, we're going to pay you $20 an hour and you're just going to process this stuff and you're going to do it over and over and over and over. And it's less of a business. It's more of a job than it is like an actual career. But you will see some variation.
I think that, you know, for anyone out there thinking of like, you know, yes, the bottom line is the bottom line. However, and I tell people, if you're okay being treated like a widget and you're okay with lack of communication, if you're okay with, you know, an online person that you're never going to get a hold of, if you're okay with that, that's fine. And I'm not scaring them. It's just, that's what it is. So if you're going to get the better rate, you're generally getting a worse employee or they're great online lenders. But if you're playing odds, you know, and it may be a fit for a buyer. It absolutely is a fit. And there's no one size fits all for a buyer.
Right.
But, you know, people are like, well, I can just get it cheaper at Rocket Mortgage. It's the same as going, I could just get it cheaper in for sale by owner. I could get it cheaper going with an agent through Redfin that charges less money, you know?
Right.
But you have to take the bads that come with the goods, and that may work for you. And if you're like, hey, I want to save a couple grand, I'm going to be just turned into a machine online and, you know, pump out my mortgage. But more often than not, mortgages have issues, like more often than not. And when you don't know until you need it, when it's like the Rocket Mortgage where you can't get a hold of, or you've talked to 15 different people, or you're past their work hours and now you just have a bot that can't, and you have to close in a couple days. That's when you start to see, dang it, maybe should have went with someone else. So
totally.
But again, not knocking them. It maybe works for certain buyers, but I think this is good for people to hear, because I think they do think like, well, they're all the same rate. What are they going to do for me? Like, why do I have to pay this one more or this one less? It's like, well, you're paying for quality of service, just like anything, you know?
Totally. Yep. It's same thing with everything that we buy. Like, sometimes the cheaper version works great because we just need
it for just a small thing, or you need it for.
I go to Harbor Freight.
It works forever.
Yeah. I go to Harbor Freight and I get certain things that I know that I'm only going to use a few times, and it's not worth me going and buying the big name brand. But if I'm going to use that tool all the time and it's reliable, I'm probably not going to buy the cheapest version of it. Yeah.
Okay. Well,
shout out to Harbor Freight.
Yeah, I know. I just think I said a certain company's online lender. I hope I don't get in trouble for it, but I was not knocking them. I'm just saying they're just different.
It is a stigma. Like, you can talk to anybody that's used an online lender, and there's probably some that have had great experiences, and others that it's just like,
and people that have been like, that have commented on my stuff and told me, oh, I sold my house myself and it was great. I'm like, that's awesome. I'm not even knocking it. Like,
no.
If it went great for you, that's totally cool, but you're the exception, not the rule.
Yes. Right.
But you always have, they're generally the loudest part of the population.
They are.
Oh, I went with an online lender. It was so great. And I sold my house myself and it was so great. No one ever needs anything, you know. It's like, okay, cool.
Yeah. Thanks.
Keep it to yourself. One I get asked a lot is, and this is really important because I think there's a lot more contingent offers and people trying to buy and sell and closing at the right times and keeping their rate. Obviously you can lock in your interest rate, and what are the terms of the rate lock? Like, kind of walk people through. Basically what this means is you're asking your lender to find, you know, we enjoy this rate that you have right now. Let's lock it in. What are some of the rules associated with that? Timelines and things like that.
Good question. So typically you're going to be able to lock in, well, not typically, you're going to be able to lock in your interest rate once we have the purchase contract for the home. So once we know that it's under contract, we can put an address in our system. The lock goes to the property. So a lot of people don't realize that it's like, you know, like you go buy a car and they get you an interest rate, and that's for you to go find any car that you want. Whereas on buying a home, it is locked to that property. If you backed out because of inspection, well, now you're no longer locked in at that rate because you got to find a new property to get locked in. Typically, it is a 30-day lock. That's kind of just the standard defaulted, because of home purchase usually takes somewhere around 30 days. you can do 45-day, you can do 60-day, you can do 90, like you can stretch it way out. And the way that you would do that, or the reason that you would do that, is because maybe it's new construction and you know that you're 4 months out, but you want to get it locked in because rates are looking worse. You're essentially, you're locking in that rate, and you're hedging for that amount of time. So locking in a rate farther down the line like that is going to cost more than it would if it was just a 30-day, because you're guaranteeing that rate over the course of 4 months.
Yeah.
And who knows what might happen in that time frame. Typically, they're done in 30-day, 45-day, maybe sometimes 15 days, depending on when you want to do it. But you're going to want to lock in right away unless you're in a market where rates tend to be getting better. And so we call that floating. So you can either lock or you can float. And there's a disclosure that goes out that you acknowledge that says my rate is locked or floating. And then it's just a matter of keeping your eye, not you as the buyer so much, but me as the loan officer, keeping an eye on the market and figuring out when the right time to lock it in. Kind of like buying and selling stocks, where you're just, there's the risk for sure in floating and waiting, but there's also can be some really good reward. And then to kind of flip it the other way too, is you can lock in. And then if interest rates get better, you can do what's called a float down option, which just means that if rates get, usually it's 0.25% better. So, which is a pretty big shift. But if you were to lock in, and then over the course of your loan, or the time getting your loan, rates got better by say 0.5 point, like it was a huge drastic change, we can do a float down, which just means that even though your rate is locked, we can make an adjustment to get it down to where the market is now. So typically once you're locked, you're locked. You can't change anything. But if the market moves enough, we can do a float down option with that. So
okay.
You're kind of
ask you about that.
Yeah, I tell people, like, once you're locked, you're locked. I want to make sure that, and I let people determine whether or not they want to be the one to pull the trigger on it, or if they say, hey, I want you just to get me the best rate you can. And so it's like,
so
okay,
there's no
cool.
time that they have to lock it in.
No, like, you can wait till
so you make the offer, it gets accepted, you could still be floating around.
Totally. I've had some where I have literally the last condition that underwriting needed for us to be able to get documents out to sign was to lock the rate, because the rates just kept getting better and better and better. So we just kept riding it out until we couldn't ride it out anymore. And it was like, all right, now we have to lock because we need to close the loan.
Okay.
But there is no set timeline. The underwriter does have to have that, because that obviously determines what your true payment is. But no, there's no set time frame. I think in this environment and how it has been over the last handful of years, I'm most of the time encouraging people to lock right away. And if we happen to get under contract when we're in a good swing of rates, then I might say, hey, let's keep an eye on this for a day or two. And if it seems to like it's going to get worse, let's lock it in. But yeah, I'm always a fan of locking it as quick as you can, unless you're in a good swing of the market where it's just steadily improving, then there's no rush, in my opinion, to lock it in.
And do rates change? When do buyers need to know when rates change? Is this a daily? Is it an hourly? Can they watch it by the hour? Or is it like every other day, or what is it?
It is daily, and it is multiple times a day.
Okay. So it's literally you could watch it through the day.
Yeah. There has to be enough movement in the market for it to actually change for most lenders throughout the day. If there's a big enough swing, then they might reprice during the day. But a lot of times, if it's just a fairly normal day, it's really not going to change throughout the day. But we have seen plenty of times where there's been multiple reprices for the better or for the worse. So it's like you get in and rates come out at 8:00, and then 2:00, they're worse. Okay. So it definitely changes. I mean, there's some stuff you can look at, like I like to go to Market Watch and then type in the 10-year treasury note. Okay. And that'll give you a really good idea on why the rates change so quickly, because that 10 years going up and down and up and down. And if it goes up for long enough or down long enough, then you're probably interest rates are going to change based on that. So it is definitely a daily, multiple times daily checking. Okay.
So it can be done.
It can be done. And most, in my opinion, most good loan officers keep an eye on that stuff. Yeah. So that they know to go, hey, today's not looking good. Let's lock this in. Let's not ride this out.
And I know this changes as the busyness and the economy changes as well, but how long does a mortgage process normally take from the time you get an accepted offer? How long are you guys currently taking to get to close?
Yeah. Right now, I think our average is like 23 or 24 days as a company. We always, I mean, kind of, it's at least ever since I've been in it, it's kind of always just been like we plan for 30-day closing when writing up an offer.
Yeah.
But we will move it up quicker. Sometimes it's a little bit, sometimes it might be 40 days, 50 days based on what the seller needs or buyer or whatever it might be. But I would say on average, you're realistically looking at from the time that you get started until the time that we're done with underwriting, you're probably looking at 2.5 weeks or so of time. And then there's, and then you got to get the closing disclosure out and then doc sign and everything. So there's a few more days that get added on there. But overall, it's usually, as long as there's not a bunch of crazy moving parts.
Yeah, it's pretty quick.
We can get you into underwriting in a week and then get everything cleared, appraisal back, everything by the end of the second week. And usually you're sitting pretty good. So
cool.
Obviously a lot of variables, but if it's a clean loan and they're, a salaried W-2 borrower that has money in the bank and there's not a lot of variables, I mean, we'll knock that thing out in a week.
Yeah. Yeah. Cool. Well, those are my questions for you, man, for this week.
Yeah.
It was good to talk to you.
You as well.
We're going to try to have some guests on, kind of switch things up a little bit. We got a couple good guests that I need to get scheduled in for our podcast.
Yes.
Anyways, like and
bring
subscribe
them on the venture
to Venture with Joe and Cody.
That's right.
Yeah, it was good to see you. And
you as well.
Until next time, we'll chat with you later.
Yeah, that sounds like a plan.
Okay, see you, man.
All right, see ya.